win too. But there's no benefit to doing that. There's no wise benefit to doing it. And the larger the company, $27 billion companies, they trade at a much lower price than $10 million companies do. $10 million companies can cost 10% for a round trip. You buy and you sell, and it's almost 5% per transaction. Which is why most of the mutual funds you'll have available to you in your 401k plan or in your mutual fund office are large company funds, because they buy and sell to try and beat the market. In the small company funds, there won't be a lot of choices available. Small company funds are where the returns come from, is where I'll show you here in the end. So the key question under the new rule of the game is this: how much better does an active manager have to be to overcome his own cost of fund turnover and the cost of his activity? Some say 5%. They have to beat the market by 5% just to overcome their own activity. Much less when they do beat the market for periods of time, they raise their expense ratios and increase what they take out of your fund anyway. These are the facts. This is just factual information. And so it's depressing. The myths are stock selection, track record investing, market timing, cost investing. Everything you thought was true about your fund manager isn't really true, or about your stockbroker, or about your financial planner. This is the kind of financial planning we ascribe to. If they're a 5-star fund chasing group. But there is truth, and we can go through it. Any questions about the first half before I dive into the second? Okay. There's an outline that we're going to go through in this one as well. We call what we do free market portfolio theory. Okay. Free markets are the philosophy. In fact, I'll just go through this. Free market portfolio theory is an investment approach grounded in academic research, grounded in the truth about investing. All right? And it's discipline focused. Discipline on your part and discipline on my part. Right? Everyone has to do what they need to do, because there's a way to look back 80 years and say, hey, if we would have done this, we would have gotten 10 or 11 or 12 or 14% return on an average. Now, there have been years where we'd have done less well, because that's what the market did. But there are activities we can be a part of, like rebalancing at those years, to bring positives to us as well. So it's a disciplined approach, your discipline and my discipline. And there are 3 components to it. The first is the philosophy, and the philosophy is that free markets work. Now, are free markets perfect? Do people lose in free markets? Yeah. But they're better than the alternative. And component 2 is modern portfolio theory. This is the academic research. We're going to go through that briefly. And component 3 is 3-factor model. That's where we practically get our returns from. These are the folks that we follow. I'd be glad to print this off for anyone. I don't think this is in your book, but I'd be glad to print this off for anyone who's interested in Googling these guys. I follow Fama and French. They have a regular blog that they do either videos or writing. They're always answering questions about what's going on. Fama basically wrote the research. He's in his early 70s now, I guess. I went to see him speak in Texas last month. A lot smarter than I can glean information, or anyone can glean information, although his research is plain, and so he plainly brings that to you, and it just shows you that the market brings the returns, managers don't. So free markets work. Component 1. This is a belief statement on my part, and if there's going to be a difference in our opinion on this statement, we're probably going to butt heads for a long time. And it's just good that we all understand this. In a free market, at any point in time, the actual price of a security is the best indication of its intrinsic value. If you say, Evan, what's GM worth today? I'll say, what's its stock price? And there are people who say, well, the market isn't completely efficient. And what they mean by that is information doesn't travel completely efficiently. Right? Someone might have information that I don't have. That means the stock price is different than I think it is. But the thing you want me to believe, rather than to believe that it could be inefficient to the point where stock prices aren't the best indication, you want me to believe this, because otherwise it's my opinion against the markets, right? The best indication of General Motors' price or value today is what 3 billion people who are all trading it today at this price, they're better at determining its value than I am. How many of you saw that book out front called The Wisdom of Crowds, and the little jelly bean thing? Did you see that? I'd like you to take a guess about the jelly beans. The jelly bean example is, Everyone's guessing, all of my clients, whoever comes in here, they're guessing how many jelly beans are in the box. And when we had 25 guesses and we averaged those guesses, we came pretty close. Karen says, I still don't know how many are in there. My receptionist has the data. When we added 25 more people to the guessing game, the average of the 50 got even closer to the real number. When we added, we're up to 150, or we're in that 175 mark. We're trying to get to 200 by next January's event. With 200 people, based on the way it's going, we're going to pretty much zero right in on the exact number when we average 200 guesses. Now that's not saying we all create truth. That's not where truth comes from. But the best indication of price, it's certainly better for me to believe that General Motors' price set by 3 billion traders is better than my opinion of the price, or better than 3 other people's opinion of the price. And so this is a very good indication of value. And if you ask me what a company is worth, I'll tell you that it's worth what its stock price is, because that's our belief system. Let's say, for example, though, that I'm wrong. Let's say free markets don't set prices. Let's say that they fail. And this is going to be on your page. Nope, we're going to get to this one yet. If free markets fail, then the market fails to price goods and services appropriately. This is in red, I guess, on the top. If free markets fail, then it's possible for some individuals to identify in advance which prices are inaccurate. And if they fail, underpriced or overvalued markets can be predicted or forecasted. By taking advantage of these mispricings in stock prices or sectors or companies, it's possible to both increase returns and avoid losses in investments. And if that's true, you should utilize traditional investment strategies. Because the only way you can do this is to stock pick, to track record invest, or to market time. That's essentially what we're saying you should do. We saw the success of that about 5 minutes ago. But if free markets fail, those are your choices. You can stock pick, you can market time, or you can track record invest. But if they work to set prices, then based on supply and demand, the price of a stock is the best indication of the company's value. I'm not saying it's perfect. Again, don't hear me say free markets are perfect. They work better than a committee. That's what I'm getting at here. All available information is factored into the current price. Only new